Welcome to the Deep Dive, your express lane to being truly well-informed on the critical business conversations shaping our world. Today, we're taking a deep dive into the latest from Pure Storage, specifically their Q2 fiscal year 2026 earnings call. For anyone tracking the pulse of enterprise storage and, well, the massive build-out of AI infrastructure, this call was absolutely packed with insights. Our mission? Cut through the noise, distill the most important nuggets, and clarify Pure Storage's strategic trajectory and latest performance for you.
Indeed. It was an earnings call that certainly got the market's attention. We'll be connecting the dots between their strong financial health, their pretty ambitious product roadmap, and what it all means for how data is managed in our increasingly AI-driven world. Think of it as a blueprint for the future of enterprise data, really.
All right, let's kick things off with the headline numbers. Pure Storage didn't just meet expectations this quarter, they significantly exceeded them across the board, delivered what can only be described as a truly strong performance. We saw non-GAAP EPS come in at a robust $0.43.
Yeah, beating the $1.39 consensus by a solid 4 cents.
And revenue hit $861 million. That surpassed estimates by about $15 million, marking a very healthy 13% year-over-year increase.
And yet what's truly compelling here, beyond just beating the numbers, is the underlying strength in their subscription model.
Ah, yes, the recurring revenue.
Exactly. This isn't just one good quarter. It feels like a profound validation of their long-term strategic shift towards predictable recurring revenue. It tells us the company is building a business that's not just growing, but is, fundamentally more stable and resilient.
That makes sense. And the balance sheet.
Incredibly solid. $1.5 billion in cash and investments and a strong $150 million in free cash flow this quarter gives them ample flexibility.
Okay, so if those are the headlines, let's peel back another layer. Let's look at where this growth is coming from and maybe more importantly, where they see themselves heading. Digging a little deeper, we saw an interesting geographical split. U.S. revenue grew 7% to $577 million, which is good.
Solid, yeah.
But internationally, revenues surged an even more impressive 26% to $284 million.
That international acceleration is certainly noteworthy. Suggests broader global demand, right?
Definitely seems that way. They also expanded their team, adding 120 new employees, and made a smart move, repurchasing $42 million worth of shares.
So the critical question then is, how does management translate this current momentum into their future outlook? How confident are they feeling looking ahead?
Well, they're feeling quite optimistic, it seems. They showed that confidence by significantly raising their outlook for both Q3 and the full fiscal year 2026. For the full year, they now project revenue between $3.60 billion and $3.63 billion.
Which is a significant bump up from their earlier $3.515 billion estimate.
Right. That midpoint implies about 14% year-over-year growth. And their non-GAAP operating income guidance for the year also got a boost, now projected between $605 million and $625 million.
If we zoom out a bit here, you'll notice a subtle but strategically important shift in how Pure Storage is presenting their guidance.
How so?
They've moved from providing single target numbers to offering a range. Now, that might seem minor.
Right, just a range.
But it aligns them with many industry leaders and, crucially, gives them more flexibility. It signals confidence, yes, but also strategic agility, the ability to make incremental investments, seize new growth opportunities as they arise, without constantly having to readjust expectations.
I see. More wiggle room, but based on confidence.
Exactly. And this guidance actually implies an acceleration. We're talking mid-teens growth in the second half of the fiscal year, driven by broad strength, better pipeline visibility, and the excitement around their new product introductions.
That's a great point about the nuance there. And this robust financial performance isn't just like a string of good quarters. It's deeply connected to their bold strategic vision, particularly what they call the enterprise data cloud. Now, for those of you who might be thinking, what exactly is an enterprise data cloud? Well, imagine your company's data like water in a city. Traditionally, it's stored in separate reservoirs, right? Each needs its own pipes, pumps, maintenance crews.
Very siloed.
Exactly. Pure's enterprise data cloud is like building a smart, centralized water grid. It connects all those reservoirs, manages the flow automatically, ensures everyone gets the right quality and quantity of water exactly when they need it, no matter where they are.
That's a good analogy.
Yeah.
And it isn't just theoretical. Introduced at their Accelerate conference, the Enterprise Data Cloud, or EDC, it's their architectural blueprint. Yeah. Built on their integrated Purity operating system, enhanced with Pure Fusion v2. It's designed to replace those traditional, often siloed storage systems with a software-defined orchestrated data service.
And the promise there is
Significant.
huge. Lower labor costs, reduced risk, and significantly increased operational agility. It's done through automated workflows and a powerful policy engine that can manage attributes like price performance, resiliency, even geofencing for compliance. And we're seeing real-world examples of this already.
We are. Concrete examples.
Yeah.
One global IT consulting leader is adopting the EDC right now to consolidate applications, eliminate those data silos. Another prominent financial institution is modernizing its whole application environment, migrating workloads to things like containers or Kubernetes virtualization.
Which helps them run apps more efficiently, more flexibly.
Precisely.
Yeah.
And they're deploying Pure Storage's new FlashArray XL This new array dramatically reduces infrastructure, needs space, power, cooling by over 70% compared to their older legacy solutions.
70%? Wow.
Yeah. And even a global automotive company expanded its use of Portworx, which is pure specialized software for managing and protecting data for modern containerized applications.
It really shows how critical these new solutions are becoming.
Absolutely. And speaking of new innovations, the Accelerate conference also showcased some really compelling updates. They expanded their FlashArray XL, ST, and FlashBlades lines. These are all designed to handle the most demanding high-performance workloads, including those incredibly data-intensive AI training environments.
And FlashBlade XL.
Specifically engineered for AI, now generally available. So it's out there.
Okay, here's where it gets really interesting for the future of modern IT, I think. They also launched Portworx for KubeVirt.
Mm-hmm.
Now, KubeVirt essentially lets you run traditional virtual machines inside a Kubernetes environment, which is typically for containers, right?
Like bridges that gap.
So Portworx for KubeVirt helps companies manage and protect data for both these traditional VMs and modern containerized applications, particularly for those running on Red Hat's OpenShift platform. It's about bridging the old and new worlds of enterprise computing seamlessly.
Exactly. It's a smart move.
Yeah.
And this also ties into their Nutanix partnership. That's generating significant customer interest already. The early field trials were actually oversubscribed.
Oversubscribed. Okay, that's telling.
Yeah. This integration, expected by the end of calendar year 2025, will expand Nutanix's hyperconverged offerings. They'll get external storage options and greater scalability via the Fusion integration. It addresses a growing customer demand for more flexible virtualization alternatives.
Makes sense. Now, let's talk about perhaps one of the biggest catalysts for Pure Storage that has everyone buzzing, their strategic engagement with hyperscalers, particularly Meta.
Yes, the Meta deal.
The co-engineering effort with Meta is, quote, on track. Meta initiated its first volume deployment, and Pure Storage already recognized initial revenue from this in Q2.
Tiny revenue so far, but symbolic.
Right. Their original FY26 guidance had assumed deployment of 1 to 2 exabytes of Pure's direct flash technology. Now they are, quote, increasingly confident about this assumption and possibly even more by fiscal year end. That's a strong statement.
It is. And what's fascinating about this Meta relationship is its financial profile. The revenue is largely royalty-based.
Royalty-based? How does that work?
It's derived from Pure, providing their proprietary direct flash technology at the storage media layer. Think of direct flash as Pure's custom-built, highly optimized flash memory. It bypasses traditional SSD controllers for, well, unmatched performance, efficiency, density.
So they provide the core tech know-how.
Exactly. And this direct approach translates into incredibly high gross margins for Pure. We're talking well above 90%.
30%.
Yep. Because the hyperscaler, Meta in this case, directly acquires the physical product, the flash itself, from the supply chain.
Right.
Pure provides the intellectual property, the integration layer. While Meta's contribution to overall Q2 gross margins wasn't material yet,
Right, still early days.
it's expected to be a multi-year catalyst. Substantial high-margin revenue contributions really ramping up in FY27 and beyond. They're targeting a double-digit exabyte shift for Meta in FY27.
Double-digit exabytes. That's just a staggering amount of storage. That's a game changer.
Absolutely. So given this success, this proof point with Meta, what does this mean for other hyperscalers? They all face similar massive data challenges, right? Definitely. And this success with Meta has clearly accelerated those conversations. Pure Storage's early-stage engagements with other top hyperscalers, they're progressing well. Testing, technology assessment, it's all underway.
So the Meta deal opened doors.
It seems so. Hyperscalers are actively looking to transition more workloads to flash data storage. They want to replace both traditional hard disk drives and even some existing SSD-based environments. Why? Well, they're seeking to dramatically reduce power consumption, physical space, cooling costs, while simultaneously increasing performance and reliability. It's a huge operational win for them.
Makes perfect sense at that scale.
It's a complex, multi-phase co-engineering motion, naturally. But the learnings from this first major customer, from Meta, are expected to significantly accelerate future engagements. It's also crucial to note they clarified they're focused on new builds for hyperscalers rather than trying to rip and replace existing infrastructure, offering a kind of one technology to rule them all approach across different storage tiers.
Interesting distinction. Okay, so beyond these company-specific drivers like Meta, Pure Storage is clearly riding some very powerful macroeconomic tailwinds too.
Oh, absolutely. The massive capital expenditure being poured into AI-driven data centers, that's huge.
And the power consumption issue?
Exactly. The ever-increasing electricity demand. These create perfect conditions for energy-efficient, dense flash architectures, which is right in Pure Storage's wheelhouse. They're a leader there. Plus, the continuous improvement in flash density and performance itself further fuels the adoption of all-flash solutions. It allows them to penetrate new tiers of storage that traditionally relied on older, slower tech like spinning disk.
And management sounded a bit more positive on the macro environment overall.
They did. They noted a more stable environment, increased pipeline visibility compared to earlier in the year, which certainly helps planning and execution. Competitively, their comprehensive portfolio from high performance to cost-effective capacity solutions, all unified by their Purity operating system supporting block, file, and object storage, positions them uniquely.
That breadth is key.
It allows them to displace inflexible legacy systems and stand strong against more niche players. We're seeing multiple wins with GPU as a service providers, for instance.
And not just for the primary storage attached to the GPUs, right?
No, exactly. That's the interesting part. Also for backup, data protection, VM needs, block storage needs within those environments. It truly highlights their strong and versatile position in the burgeoning AI space.
Right. Okay, we've mentioned subscription services a few times, but maybe we should just underline how central and strategic they are to Pure Storage's entire financial model.
Definitely worth emphasizing.
Subscription services revenue hit $415 million. That's nearly half, 38% of their total revenue this quarter.
Almost parity with product revenue.
And annual recurring revenue, ARR, is at $1.8 billion, plus a 22% increase in remaining performance obligations, RPO, to $2.8 billion. For you, the listener, RPO is essentially contracted future revenue that's already in the pipeline. It's a strong indicator of future predictability, right?
It's exactly right. It provides significant forward visibility. And their Evergreen One offering, that's a key part of this. It provides consistent customer value. It protects customers against future uncertainties around capacity needs, performance, pricing, even technology obsolescence.
So it's like a never get stuck with old tech guarantee.
Kind of, yeah. Essentially, it ensures customers always have the most modern technology without disruption, almost like a never-ending upgrade plan. And this shift towards recurring services is strategically invaluable, not just for that predictability we talked about, but for gross margins.
Oh, the margins.
Subscription services typically have higher gross margins. They were 76.5% in Q2, compared to product gross margins at 68%. Now, the exact mix between as-a-service and traditional product sales can fluctuate quarter to quarter.
Sure, that's hard to predict perfectly.
But the sustained growth in both, coupled with the higher profitability of subscriptions, is expected to maximize overall margins moving forward. The CFO also clarified that Q2 product gross margin improvements were driven by a favorable revenue and product mix towards higher-end solutions alongside strong pricing discipline. So, good execution there too.
Okay. As always, our This Is Not Financial Advice segment is purely for entertainment and to spark your imagination. It's a thought experiment, folks, not a recommendation.
Definitely not advice. But given Pure Storage's Q2 results, and particularly that incredible hyperscaler momentum we discussed, here's a thought for your internal investment committee to mull over.
Okay, let's hear it.
The market might still be underpricing the compounding effect of that high-margin, royalty-based revenue stream from hyperscalers like Meta.
You think it's not fully baked into the stock price yet?
It's possible. If Pure achieves, or maybe even exceeds, its double-digit exabyte shift target with Meta in fiscal year 2027, and manages to secure even one additional material design win with another hyperscaler. Well, the current FY26 guidance even though it was raised, could prove to be quite conservative.
Because of those crazy high margins on the royalty revenue.
Exactly. Those 90% plus gross margins, once that revenue stream truly scales, will disproportionately accelerate overall profitability in a way that typical product revenue simply can't. Now, hyperscaler adoption can be slow. These are complex deals.
Takes time.
It takes time, but Pure's co-engineering approach and the clear economic benefits of direct flash for AI-driven data centers suggest they've found a repeatable model. So a strategic bet could be a long position in Pure Storage, stock ticker PSTG, maybe structured via a long-dated call option spread, targeting an implied valuation of, say, $95 by the end of calendar year 2026.
A call spread to capture upside while managing cost.
Precisely. Such a play would aim to capture significant upside while managing the capital outlay for what could be a potentially explosive multi-year re-rating of the stock. It's a bold idea, certainly, but the numbers, the trends, they paint a compelling picture. Food for thought.
Definitely food for thought. And that wraps up our deep dive into Pure Storage's Q2 FY26 earnings. It's clear the company is executing strongly, navigating a complex macro environment with strategic product innovations and significant partnerships that are, well, truly paying off.
Their relentless focus on the enterprise data cloud and their game-changing direct flash technology for hyperscalers. It positions them right at the forefront of critical industry shifts, especially as AI continues to fundamentally reshape data center requirements globally.
We hope this deep dive has given you a clearer, more insightful understanding of Pure Storage's trajectory and the wider enterprise storage market. Remember, all information presented is for informational purposes only. It is not financial advice.
Absolutely. We always encourage you to continue your own research and due diligence. Here's a thought worth exploring long after this deep dive ends. As enterprises increasingly treat data as their most strategic asset in the AI era, how quickly will the remaining legacy storage systems truly become a relic of the past? And what does that mean for the next generation of data management leaders?
A great question to ponder. Thanks for joining us on the deep dive. Until next time, stay curious and keep learning.